Welcome to Tax Insights, presented by Hawkins Ash CPAs.
And good morning, listeners. Welcome back to Tax Insight here on the Lakeshore's good neighbor, WOMT. We got Ryan joining with us once again here this morning. Ryan, good morning, sir.
Good morning, Terry.
Hey, we are talking about a topic that I don't think we've ever covered here on the show, and step up in basis at death.
Yeah, this is a question that comes up quite often. Last week we talked about the gift tax rules. This week we're going to talk about what happens at death. And this gets a lot of press typically in an election year because politicians do call it a tax loophole that needs to be closed. I'm not going to categorize it as a loophole, but I'll say it's a tax provision that impacts far more than just the rich.
Absolutely. So let's start off with, first and foremost, explaining what exactly is the step up in basis at death.
Yeah, so this is a tax rule that says when someone passes away, most of their assets will receive what's called a new tax basis and new holding period. And that new tax basis is equal to the fair market value of a particular asset on the date of death, regardless of what the person originally paid for it. This basically allows someone's heirs to know what the income tax consequences will be after death. And so a quick example, let's just say I bought some hunting land 10 years ago for $100,000, and today it's worth $150,000. If I were to die, my heirs can take that land and sell it for $150,000 and not pay any capital gains tax on it because the basis is reset to whatever it's worth at date of death. Again, that's a rule that just simplifies things for people when they pass away.
So you said the step up applies to most assets. What doesn't it apply to then?
Yeah, good question. The biggest example that it does not apply to is something called income in respect of a decedent, or IRD. The most common example of an IRD asset would be someone's IRA, 401k, 403b, or other tax-deferred account where there's never been tax associated with that account. There's no step up in basis on these assets. So if I pass away, my 401k or IRA is still paid out to my heirs and subject to income tax at that time. Another common asset that does not get a basis change is life insurance when it's paid out at death. However, those usually aren't subject to income tax anyway.
So are there other exceptions or rules then that listeners should be made aware of?
Absolutely. We're going to cover the most basic ones that apply to most people here. First, and this is very relevant this year, note it can actually be a step down in basis. And so an example of that would be I bought stock in Apple earlier this year when it was trading at around 170 a share. This month it's trading at 140 a share. If I were to pass away before selling that stock, that $30 loss on that stock simply vanishes. It goes away. My heirs will take it at $140 a share, not the $170 I paid for it originally. Second, there's important rules when we're talking about married couples, and in particular, a state like Wisconsin, which is a marital property state. With proper planning, there's some tax advantages that can be taken advantage of. On the flip side, there's pitfalls that can be out there if you don't have proper planning. Lastly, last week we talked about the gift tax rules. Be aware that if someone gifts an asset other than cash, they are giving up that step up in basis that would otherwise be available at death.
Ryan, a lot of great information here on today's program. If listeners want to connect with Hawkins Ash, what is the best way of doing that?
Yeah, the first thing they can do is go to our website at www.hawkinsash.cpa. They can contact one of our estate planning professionals, follow us on Twitter, or like us on Facebook.
Ryan, thank you for your time, and we'll talk to you next week here on WOMT.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs, part of your business, part of your life.